don't get into gold, don't get into silver. It's so volatile. I said in January, gold and silver were due a pullback. The pullback has been aided by naked paper sales. Gold and silver don't do anything. They don't go up, they don't go down. The yardstick says that the dollar has lost 95% of its value. Was that they could bully markets with derivatives to make them go up or to make them go down. And that's what they've done. JP Morgan paid $920 million for bullying silver. Paper markets are the tail. Physical markets are the dog. The tail for years and years has wagged the dog. But if you look at the physical markets, silver's got a 450 million ounce per year deficit. And in the words of Elon Musk, you can't short a shortage. The demand is for 99.99 fine. For both gold and silver by the end of the year, we're going to be at new highs. Yeah, I'm just going to give you the biggest dot of all. Get out of the system. Because when this happens, you're not going to have access to your cash. You're not going to have access to your stocks, your insurance portfolio. You're not going to have access to anything.
Just in the past 2 months in gold and silver, how can anybody say that that's something that can be relied upon to be their steady source of core holdings in their portfolio? What do you respond to that?
They've said, don't get into gold, don't get into silver. It's so volatile. And they've said it forever. And I guess, go back to the year 2000. They're telling you, stay out of gold at $300. Don't buy $4 silver. It's just too volatile. Well, guess what? Yeah, it was volatile. It was volatile to the upside. Gold and silver have been the best place to have money since in this century. And it just sits there and sleeps and cannot default.
The types of volatility that we've seen in nominal price for metals, how do you contrast that with the intrinsic utility or the intrinsic value that is unchanging despite those fluctuations in nominal price over time?
Well, first off, and let's go back to what do you say to these people? First off, gold and silver don't do anything. They don't go up, they don't go down, they don't eat, they don't argue with you.
Many investors ignore that volatility can mask long-term security. As Bill Holter points out here, gold and silver have historically outperformed despite short-term swings, challenging the narrative that volatility is inherently risky. Headlines warn of unstable metals, yet since 2000 both have delivered steady real gains, with periods of nominal fluctuation largely irrelevant to intrinsic value. Holter emphasizes that these assets don't generate liabilities, consume resources, or fail under pressure, meaning their stability isn't reflected in day-to-day price noise. Next, Bill Holter discusses how this hidden reliability underpins portfolio core strategy.
You get to sleep at night knowing you're not going to default. What happens is the currencies go up and down, and that's reflected in the measuring stick, in the yardstick. The yardstick is gold. And what the yardstick is saying is that, going back to the year 2000, and let's just use $300. The yardstick says that the dollar has lost 95% of its value, whatever the math works out to be. Since the year 2000, the dollar has lost that much. You could buy 1 ounce for $300, or $1 was 1/300th of an ounce. Now $1 is until a couple days ago, is 1/5000th of an ounce. Now it's 1/4500th of an ounce. So it's gone up 15-fold if you look at gold going up, but that's not what happens. It's the dollar going down.
For those who are trying to plan a judicious time, a prudent time, a responsible time to add more of this intrinsically valuable asset, gold or silver, to their core holdings, their portfolio, what do you tell people who are watching from the sidelines now and waiting for perhaps further declines that we've seen since January 30th, wondering if this is the right time for them to step in?
Many assume gold's price rise reflects speculative frenzy, but the real story is the dollar's collapse. As Bill Holter points out here, the dollar has lost roughly 90 to 95% of its purchasing power against gold since 2000. turning $300 per ounce into an effective 145/100th of an ounce today. Investors waiting for the perfect entry overlook that the currency itself erodes savings faster than any metal swings. Holter frames gold and silver as intrinsic hedges, not timing instruments, reminding us that strategic accumulation matters more than chasing bottoms. Next, Bill Holter talks about the timing and prudence of adding these assets.
What's your philosophy around a big picture strategy that people should adopt just to take care of their family's financial future?
Well, gold and silver, and I said in January, gold and silver were due a pullback, without a doubt. And the pullback has been aided by naked paper sales. I mean, the naked paper sales have been used since 1975, since the COMEX began. But they really learned in 1987 when the market crashed, because a whopping $6 million is what saved the system. The only options that were open, I think, were not the S&P 500. It was Value Line, or one of the smaller ones, and $6 million went into that, and it saved the market. And what they figured out after that event was that they could bully markets with derivatives to make them go up or to make them go down, and that's what they've done. And I mean, there's proof of that. JP Morgan paid $920 million for bullying silver from 2005 to 2013.
Wall Street. Whisper. Market narratives about natural pullbacks ignore deliberate manipulation. As Bill Holter points out here, naked paper sales and derivatives have historically been used to control metal prices, from COMEX tactics in 1975 to JP Morgan's $920 million silver fines between 2005 to 2013. Investors rarely see that reported in mainstream coverage, creating a false sense of organic price movements. Understanding these interventions reframes volatility as a systemic artifact rather than market truth. Next, Bill Holter shows how derivatives distort real asset allocation decisions for family wealth preservation.
Paid a $1 billion fine. Just understand that if you were thinking about buying gold or thinking about buying silver in January at the peak, with silver, you can buy the same ounce 40-45% less, and the correction has already taken place. I mean, it's not possible because they can't default, they can't go to zero. And if you look at the demand side, the physical market, the real market, paper markets are the tail, physical markets are the dog. The tail for years and years has wagged the dog. But if you look at the physical markets, silver's got a 450 million ounce per year deficit. And in the words of Elon Musk, you can't short a shortage. And that's what's happening at this point. So once this episode is done, you're going to see, I think it will only probably take 60 to 90 days. You'll see new highs in both gold and silver from wherever the bottom is. And I don't think it's going to be much further from where we are right now.
Many assume correction signal danger, but real scarcity tells a different story. As Bill Holter points out here, silver faces a structural deficit of roughly 450 million ounces annually, and physical demand drives markets more than paper instruments. Recent price drops of 40 to 45% merely reflect market noise, not default risk. Investors who focus only on charts miss the longer-term trajectory fueled by tangible shortages. Holter reminds us that shortages are unshortable, making strategic accumulation critical for portfolio resilience. Next, Bill Holter unravels how physical deficits will drive future highs in metals.
What about the phenomenon we've seen of collapsing premiums in both pre-33 gold, the semi-numismatic gold, as well as the 90% silver, affectionately referred to as junk silver, the 90% constitutional silver coinage? What's your outlook for, do you see those as screaming opportunities right now for people who are looking to add on?
Absolutely. Yeah, with gold, but particularly in silver, I mean, you can buy it spot or below spot. It's a United States problem because they're U.S. coin, and they're not 99.99 fine, and the demand is for 99.99 fine. It's the demand from the central banks for gold. They're not going to accept 90% gold. They don't want beautiful historic coins. They just want the gold. And with silver is used. Silver is used in industry. It's used in military applications. It's used for medicinal purposes. The green energy stuff. All of that silver's got to be 99 fine.
Many see collapsing premiums as a warning, but they mask opportunity in tangible metal. As Bill Holter points out here, pre-33 gold and junk silver can be acquired at spot or below, yet central banks only recognize 99.99% fine gold, showing the disconnect between collectible and functional value. Silver's industrial demand, from military to green energy applications, underscores that market scarcity is structural, not speculative. For long-term investors, the overlooked nuance is quality and utility over historical charm. Next, Bill Holter discusses why these overlooked coins still represent strategic accumulation potential.
So the reason the premiums have collapsed is because, especially in junk, the premiums have collapsed because really the only way to buy silver back in the 70s and 80s was to buy junk silver. That was the prevalent form for Americans to buy. They sat on it for 40, 50 years. Now they've had a chance to get out. A lot of them did sell, and that selling, brokers only have X amount of dollars. You know, you may have a broker that's got a $50 million credit line, 100, 200, whatever, but that credit line gets eaten up. And because nobody's going to hold junk as inventory, it goes directly to a refiner. The refiner refines it down to 99.99 fine, and then they pay the dealer. Then the dealer gets paid, and at this point, that's about a 6 to 8 week process for dealers to get paid. So that's why the dealers have backed away price-wise, because they know they're not going to get paid for another 6 to 8 weeks, and they're tying up their capital. It's a financial problem. It's not a coin problem.
Collapsing premiums appear as weakness, but the mechanics reveal structural inefficiencies. As Bill Holter points out here, long-held junk silver from the 70s and 80s flooded the market, and brokers' finite credit lines created artificial downward pressure. Refiners process coins into 99.99% fine silver over 6 to 8 weeks, locking up capital and delaying dealer payouts. Investors often misread this as market decline rather than liquidity and operational constraints. Recognizing these nuances clarifies risk versus opportunity. Next, Bill Holter shows how supply chain and credit limitations influence apparent metal price drops.
Now, that said, because these things are getting melted down, how much supply is going to be left in 6 months or a year? Because everything that's been sold is getting melted down.
Yeah, you've been separating out the physical market, which is the dog, versus the paper price influence, which is the tail wagging. What is your outlook on this particular question of, given the structural deficit in physical supply versus demand for silver in particular, given the ongoing military hostilities that seem to be escalating and broadening everywhere you look, given the inflationary likelihood of debasing the currency that central banks are likely to do in times of war, what's your outlook for the rest of the year for the precious metals, for people who want to see the way that you see the markets looking forward?
Well, I think I can easily say for both gold and silver by the end of the year, we're going to be at new highs.
Can you give us some more color behind that?
I'm not going to give you a date. It was just a video put out by John A.G. I don't know if you saw it or not, but he said, Holter's had a perfect track record, blah, blah, blah. The only problem is I'm not foolish enough to give a price and a date at the same time. Now, what I'm saying is, and I feel weird saying by the end of the year, because that's giving a date, and new highs, that's giving a price. But I think 9 months out from now, I think this episode will be far, far behind us. It would only be a blip on what the chart looks like in 3 to 5 years. I mean, if you go back and you look at charts, 2008, 2009 doesn't look as scary as it was at the time. 1987 doesn't even look like a pimple.
Short-term fluctuations obscure the structural deficit in silver supply. As Bill Holter points out here, melting down sold coins removes physical inventory from the market, compounding scarcity amid global inflationary pressures and military conflicts. Headlines ignore that paper pricing dominates perception, while tangible metals dictate real value. Historical charts from 1987 and 2008 show volatility fades in context, illustrating the long-term trajectory for precious metals. Investors who focus only on temporary swings risk misjudging opportunity. Next, Bill Holter talks about how this structural scarcity will define gold and silver's performance over the year.
For clients who call you and are trying to make first step decisions, what strategies do you suggest to them as far as, looking for a good entry point and then putting their whole nest egg in where they want to, or doing things in multiple steps and tranches over time?
In days past or years past, time past, stepping into it step by step, doing 5 tranches or whatever, that's a good strategy. At this point, when people ask me how much should I put into gold or how much should I put into precious metals, my standard answer is whatever you don't want to lose. Because when this goes, whatever you don't have in precious metals is going to have a counterparty. And there's counterparty risk. There's going to be a broker involved, or a bank involved, or an insurance company, some type of financial institution involved. And the question is, when the shithouse comes down, is that institution going to survive? And the answer is likely no. So my standard answer is, whatever you don't want to lose, put into precious metals, because they can't bankrupt. And bankruptcy is the future of the world.
Entry timing debates overlook systemic risk entirely. As Bill Holter points out here, incremental buying, using multiple tranches, protects investors against counterparty failures in banks, brokers, and insurance companies, which could collapse under financial stress. Precious metals are unique in their immunity to institutional bankruptcy, offering tangible security in uncertain markets. Ignoring this exposes portfolios to structural risk that equities or paper assets cannot hedge. Holter underscores that conservative allocation based on what you cannot afford to lose is the only reliable strategy. Next, Bill Holter discusses why incremental accumulation shields investors from systemic failures.
Yeah, I'm just going to give you the biggest dot of all. Get out of the system. Because when this happens, you're not going to have access to your cash. You're not going to have access to your stocks, your insurance portfolio. You're not going to have access to anything. And even if you did have access, you'd be down 60, 70, 80, 90% if you were able to sell. I would just say I've talked about the great taking, 100 times now. Take the hour to read or watch The Great Taking and understand that it's very, very real. It's 100% real. The laws are on the books. When you put money into a bank, you're no longer a depositor, you're a lender. When you put money into a brokerage house, and I just did this, I don't keep any stock at a broker. I did move some stock, I think it was last Thursday or Friday, I brought it into the broker's office, and it was a younger guy, maybe 25, late 20s, and he goes, wow, I haven't seen one of these in forever. And he's talking about the stock certificate.
Access to your money is a fragile illusion under current law. As Bill Holter points out here, once you deposit funds, you are legally a lender, not an owner, exposing your assets to systemic failure. Even accounts that appear safe are subject to collapse, with potential losses of 60 to 90%. Stock certificates, once common, now serve as rare reminders of tangible ownership versus digital bookkeeping. For investors, understanding this distinction is critical to protect their wealth beyond regulatory promises. Next, Bill Holter shows why reclaiming direct control over assets is a non-negotiable survival strategy.
And I asked him, I said, have you read The Great Taking? He goes, what's that? I said, when you go out of business, these shares that I'm depositing, they're gone. They're on your balance sheet. I'm going to lose them. That's why I don't keep anything with you. So it took him about 10 or 15 minutes to go through the process of taking the certificates in. But when he came out from the back room, he goes, I'd never heard about that. He goes, really? When I deposit money in the bank, it's not a deposit. I'm a lender. I said, you can bet your ass. It's in law. I mean, the ink is dry all over the Western world to fleece investors everywhere. And it doesn't matter whether you have 10,000, 10 million, or a billion. It doesn't matter. If your institution goes down, you're toast.
What the traditional retort to that claim is, everything's protected by the FDIC up to $250,000 per account. I don't have to worry about that. What do you say when clients give you that?
I would say, I would ask the question, well, let me ask you this. Do you believe that the U.S. government is broke? And 95% of the people, when you ask that question, they'll say, well, of course it is, but it doesn't matter. In this case, it matters because who's the backstop? Who's the insurance company? And I think the biggest laugh of all, and I did an article on this, probably 12 years ago, maybe more, back when CDS was, it was a big thing, and there was CDS, big movements on various sovereign bonds. The biggest joke to me is that there's CDS on U.S. Treasuries. How is that possible? How is an insurance company going to pay for the default of the U.S. government? So, you could buy all the CDS you want. You're not going to get paid.
You're talking now about insurance companies claiming that they're providing a backstop for all kinds of things.
Insurance and regulatory assurances are illusions under systemic strain. As Bill Holter points out here, deposit protection via FDI or credit default swaps on US Treasuries is meaningless if the government or insurer cannot backstop failure. Investors trusting these mechanisms expose themselves to catastrophic loss, regardless of account size. Understanding that legal frameworks prioritize the institution over the individual is key. This makes tangible, non-defaultable assets essential for preservation. Next, Bill Holter talks about how relying on paper promises over physical ownership can be a fatal misstep.
In this case, it was sovereign bonds. We've also had that in terms of pension plans, many companies that had private pension plans in the past and had made promises and commitments to their pensioners that they would continue their payouts, did what they called pension risk transfer. They transferred that risk off to insurance companies. Insurance companies said, we'll take it on. We'll take it on. Don't throw more on our back. We can take more. Because it's a very lucrative business for them as long as the system holds together. But what happened when the kryptonite shows up?
That it's over. If a pension goes out of business or two or three, they can probably backstop that. Can they do that if the entire system goes? No. It's a joke. Your true CDS, your true insurance policy is physical gold and silver. End of story. Because they cannot default and they are real money. And when this thing goes, you're going to have capital from all over the world trying to find the last safe havens that can't default. And by definition, gold is money and silver is a hybrid money, but neither of them can default.
Pension transfers and sovereign bond hedges give the illusion of safety while concentrating systemic risk. As Bill Holter points out here, insurance companies can manage isolated defaults, but when the entire financial structure falters, promises evaporate. Physical gold and silver remain immune, representing real, non-failing value. Investors ignoring this risk expose their retirement funds and savings to cascading failure, while global capital will inevitably flow toward these ultimate safe havens.